As of 10:20 a.m. Eastern Time, Datavault Inc., ticker DVLT, is trading live at $1.63 per share. That is up about 4.49% or 7 cents on the day. This isn't just a casual drift upward, this is a high-stakes, volatile battle. The stock has already swung between $1.57 and $1.69 this morning, and this is happening on significant, concentrated volume. What's happening here is a classic case of market expectation colliding violently with a new, almost unbelievable reality. The expectation for a sub-$2 NASDAQ-listed stock with AI in its name is that it's just another speculative low-float gamble. It's the kind of stock that traders on the Robinhood app might flip for a 10% gain, assuming it's all hype. The reality, however, is that this company just dropped a series of press releases that have fundamentally and perhaps dangerously changed its entire narrative. The volatility we're seeing isn't random. It's the market's desperate attempt to price in a future that is either astronomically bright or a complete fabrication. We are watching a high-stakes bet on execution, and the market is profoundly divided. The common belief, and what many who are just glancing at their SoFi Invest dashboard might see, is a company that recently changed its name from WiSA Technologies. They see a history of losses, a 52-week range that has been brutal, from 25 cents to over $4, and they see a microcap stock. The assumption is that this is a company on its last legs, using the AI moniker to stay relevant. But that is a dangerously incomplete picture. The reality, which is forcing a reevaluation from everyone, even those using sophisticated interactive brokers platforms, is what the company announced just this week. On November 11th, Datavault AI issued revenue guidance. This wasn't a small adjustment. They guided for 2025 revenue to be in the range of $30 million to $60 million. For 2026, they are projecting revenue to exceed $200 million. To understand why this is causing an earthquake in its shareholder base, you must know that this company's entire revenue for all of 2024 was just $2.7 million. This isn't guidance for growth. This is a guidance for a complete transformation. It's a statement that they believe they are on the verge of becoming a major player. This is the central tension driving the stock today. The market is trying to figure out if that guidance is credible. The bears, and there are many, are pointing to the company's most recent quarterly report. For the second quarter of fiscal 2025, they reported revenue of $1.7 million. Yes, that was a 467% increase year over year, which is impressive, but it's an increase from a microscopically small base. How does a company go from a $1.7 million quarter to a $200 million year in just 18 months? This is where the story gets even more complex. The company is burning cash at an alarming rate. The Q2 financials show a net loss of over $37 million. Its cash from operations was a negative $6.8 million. The only reason its cash balance didn't collapse was due to $12.8 million in financing activities. This is a company that has been substantially diluting shareholders to survive. The bears see the $200 million guidance not as a promise, but a desperate attempt to attract the capital it needs to keep the lights on. They are shorting this stock, betting that the cash burn will win out long before the revenue ever arrives. But then there are the bulls. The bulls are not just looking at the top-line guidance, they are looking at the why. Datavault AI is aggressively shifting its business model. The old company, the acoustic science division with its WiSA Tech, is now the legacy business. The new company, the data science division, is what this is all about. Datavault is claiming to be a leader in AI-driven data monetization and, most critically, the tokenization of real-world assets, or RWAs. This is a high-concept Web 3.0-centric business. They claim their platforms like Datavault Bank and DataScore allow governments and corporations to take physical, illiquid assets like real estate, intellectual property, or even unmined minerals and convert them into tradable digital assets on a blockchain. The press release from November 11th stated they are in dozens of contract negotiations with governments and corporations around the world to do exactly this. Furthermore, just yesterday, they announced a $150 million strategic investment agreement with Skylex Holdings. This $150 million, if it closes, is the lifeline. It's the reality that could fund the expectation. So, as we watch DVLT churn at $1.63, this is the war. The bears see a $37 million quarterly loss and astronomical, unbelievable guidance. The bulls see 467% revenue growth from a low base, a $150 million financing deal on the horizon, and a pivot into one of the hottest sectors in finance, RWA tokenization. This is why the volume is so high. It's a binary bet. This is not like analyzing Apple stock or Nvidia stock, where you are debating PE ratios and established market share. This is a question of survival versus explosion. This is a true self-investing play, the kind of name you'd find in an individual brokerage account, not something a Fidelity Wealth Management advisor or an automated Schwab Intelligent Portfolio service would ever recommend. It's too hot, too speculative, and the range of outcomes is too wide. A SoFi robo-advisor would run from this. This is for the investor who has done their homework and is willing to lose their entire investment for a chance at a 10, 20, or 50x return. Let's dig deeper into the actual business model because it's dense. The company now has two arms. The acoustic science division is the old WiSA Tech, which uses patented technology for wireless high-definition audio. It also includes ADIO, a data over sound platform. This is a real, tangible business, but it's not the growth story. The data science division is the entire bull case. This division is built on what the company calls its patented AI-driven scoring and risk analysis tools. The idea is that before you can tokenize a real-world asset, you must be able to value it and assess its risk. Datavault claims its AI, DataScore, can do this, creating a compliance-driven valuation. This is what they are licensing to these alleged government and corporate clients. It's a picks and shovels play for the RWA market. They want to be the trusted third party that verifies and values the asset before it's turned into a token. If this sounds highly ambitious and incredibly difficult, it is. But if they are successful, they would be creating a foundational piece of infrastructure for a multi-trillion-dollar market. This is why that $150 million Skylex deal is so critical. It's not just operating capital, it's validation. It's an outside firm giving them a stamp of approval. However, and this is a massive however, the deal is pending shareholder approval. It is not a done deal. This is a major risk overhang. What if it falls through? The company's cash position is precarious. They need that capital. This is the kind of detail that retail traders on Robinhood might miss, but which professional traders on the Fidelity trading platform are watching like a hawk. They are reading the SEC filings, not just the press releases. Another red flag for the bears is the recent announcement of a 1 coin per share digital token distribution. While this sounds exciting and engages the Web 3.0 crowd, it adds another layer of complexity. What is this coin? What is its utility? Or is it just a financial gimmick to attract a new class of Robinhood crypto investors? Let's frame the future outlook because it's as stark as it gets. The bull case is simple. The $150 million Skylex investment closes. The company uses that capital to finalize these dozens of RWA contracts. The revenue guidance of $30 million to $60 million for 2025 proves to be not just achievable, but conservative. The market, which is currently valuing this company as a speculative, cash-burning penny stock, is forced to re-rate it as a high-growth AI and Web 3.0 infrastructure play. In this scenario, the stock doesn't just go back to its $4 high, it goes significantly beyond. The bears are forced to cover their massive short positions, and a historic short squeeze ignites. This becomes a life-changing online investment for those who got in early. Now, the bear case, which is arguably more grounded in the company's financial history. The bear case is that the $200 million guidance is pure fantasy, a fake-it-till-you-make-it number designed to attract capital it needs to keep the lights on. The Skylex deal, for any number of reasons, fails to get approved or falls apart. The dozens of contracts turn out to be non-binding letters of intent. The $37 million quarterly loss is the real story, and the cash burn accelerates. The company is forced into more and more toxic dilution or, worse, a reverse stock price split just to stay listed on the NASDAQ. The 1 coin distribution is forgotten and the stock slowly bleeds back to its 25-cent low, wiping out everyone who believed the hype. This is not a stock for Fidelity mutual funds or a safe Fidelity IRA. This is the absolute edge of high-risk online investing. It's far removed from the stable, predictable world of Fidelity ETFs or even the volatile but established world of Tesla stock. So, as we watch DVLT hold $1.63, the question for every investor is, which reality do you believe? Do you believe the press releases, the 467% growth, the $150 million deal, and the $200 million guidance? Or do you believe the $37 million loss, the history of dilution, and the high-risk nature of a sub-$2 stock? This is the core of investment help, is learning to read both sides of the story. Based on this, comment below, do you think this $200 million guidance for 2026 is a real target or is it a complete smokescreen? In summary, the expectation for Datavault AI is that it's a cheap, forgettable AI-branded microcap. In summary, the expectation for Datavault AI